Yeah, sure. Thanks, Stu. Hopefully, those who are logged into the call, sitting in front of a computer screen, will now have on their screen the AT&T report. Just a few words on the genesis of this report before we go into any detail on it. I think the first thing to say is that one of the key issues I think that all corporations are facing at the moment is being held to account more, or at least we're trying to hold them to account more. And at the root of that has to be how they report on what they're doing, why they're doing it, how well they're doing. So the whole question of corporate reporting is now a major agenda item. And when we started doing maturity analysis, that was one of our key objectives, is to provide a much bigger, better, richer, deeper, more insightful picture of what's going on in organizations by providing a more comprehensive report. And that's very much what maturity analysis is all about. When we started to do this sort of work, it led Harvard Law School to contact us at the beginning of this year. And they said, this is very interesting. We'd like to know more about what you're doing. Excuse me. And we started to work with the Harvard Law School guys. And to cut a relatively long story short, we actually took them through the Maturity Institute orientation to explain the methodology that sits behind these sorts of reports. And when we take them through the orientation, and the reason they were working with us is we are planning to do, in conjunction with Harvard Law School, a complete rating of the whole of the S&P 500 using this maturity analysis rating methodology. But at the end of the orientation, the two guys from Harvard said to us, so, give us a full insight to one of the companies on the S&P 500 so we know exactly what we're going to produce in terms of the S&P 500 index. And we said, okay, well, do you want to give us a company that we can look at? And they chose AT&T. So that's the genesis of this particular copy of this report. But actually, it's the first time, as far as we know, that anybody actually tried to produce what we would call a totally integrated report. So by integration, and I'll introduce Nick to take this forward in a moment or so, but anybody who knows anything about the accounting profession's issues with integrated reporting will know that there is an international framework now that includes things like intellectual capital, social capital, human capital, which is not actually captured at all in normal conventional reporting. So we decided that we would capture all of that from an integrated point of view, but we needed the expertise and the skills and the insights of a very well-trained accountant who was not just an accountant, but one that actually always had an interest in what I might call the people dimension of organizations. So this was the very, very first attempt to incorporate the human side with the financial side, if I can put it that way. So I'm going to hand over to Nick now, because Nick was instrumental in turning what was going to be a human capital report, if you like, but made it into a complete report by making sure it totally blends with the financial analysis of what's going on at AT&T. So, Nick, can I hand over to you?
Great, thanks, Paul. Hi, everybody. Obviously, we can't go through in great depth because there was the report that you actually saw a copy of is in fact a summary of a fairly detailed analysis we did with a lot more ratios and connections and linkages. My interest has always been in trying to get behind the numbers. I think, as Paul said, there's the whole movement around greater transparency, getting greater awareness of what organizations are doing, greater accountability. But I think, you've got to put this in the context that one of the challenges that I and a number of members in the profession, unfortunately not a large enough number yet, I don't think, recognize that if you look at the financial information, in particular the three financial statements, but also the management discussion and analysis, and to a degree the documentation that, for example, is filed with the SEC in the US, the core financial information certainly, as we know, tells you historical information. And in a lot of cases, in terms of risk assessment and being able to determine the health of the financials, it really doesn't tell you a great deal about what's going on behind the numbers. And AT&T was a really good example, because AT&T is an organization that's in massive transition. If you look at the global phone business, I mean, you can look at British Telecom, you can look at AT&T, you can look at Bell Canada here in Canada. All of these organizations came out of landline organizations and essentially are still in that business, but are trying to make the transition to not only both a landline and a wireless business, but also broadly a media delivery business. And this is a massive shift from a capital-intensive business to a people-intensive business and content-intensive business. And so what I set out to try and do in this sort of experimental report, and as Paul says, we are learning the process as we go, is to try and do two things. The first is, well, three things, I guess. The first is to go and have a look at what the financial analysts have already done in terms of looking at the financial performance of AT&T. And as most of you know, there's some really, really good information out there in terms of tearing the financials apart. But what I was interested in looking at is how does that relate to how they're using the various different assets, and in particular, human capital, but also relationship capital, manufactured capital, what they're doing behind the scenes to drive the future sustainability of earnings and cash flow and generally health of the business. And we can start by saying, all right, from that initial financial information, so that was my first part of the research, we also know that typically the marketplace knows that financial information doesn't provide the whole story. If we look at most organizations today, and the various studies that have been done will show you, I think the most recent number is that an average of 19% of an organization's worth in the marketplace, so its value attributed to it by shareholders and other buyers of the organization, including in mergers and acquisitions. The 81% is composed of other stuff that ends up on the balance sheet of the acquiring company as goodwill. And really that more and more in a knowledge economy is what goes to drive the numbers. So the second thing after looking at the financial information was to go and look what sort of bridge do we have that exists between the existing financial information, so the traditional financials, and what the marketplace is saying that they believe the earnings stream of that company is worth. What's it worth from an investor point of view? What am I prepared to pay for it? Because as we start to look into that, we get some idea as the degree to which the marketplace has looked at the company and said, wow, this company is worth either no more than what is on its balance sheet, or it's worth significantly more than it's on its balance sheet. And in cases where we're talking about high technology companies, for example, or pharma, or people that use a great deal of human capital, that multiplier is significant. So we started having a look at this, and we tried to start correlating other filing information. Now that may include filing information with the SEC or other bodies, but also looking at other information like the company's website on corporate social responsibility, the company's website in AT&T's case on R&D, doing Google searches on financial settlements, union settlements, looking for statements that have been made by the CEO that give you some idea of strategically where the company's going, looking at the company's own website to see the degree to which that they have recognized there are risks associated with the transition that they're going through into human capital. It's very interesting in AT&T's case because they've just gone through this massive acquisition of DirecTV. And all of us know that an acquisition is something significant to digest for a company. And what's interesting, they talk about the ability to save $1 billion, I think it was $1.5 billion, or maybe it was 2.5, I can't remember off the top of my head, but a significant number of expenses being saved as a result of the acquisition and integration. But there is nowhere in the report that they talk about the risks associated with realizing those savings in terms of the impact it'll have on the human capital of the organization. And we know that in mergers and acquisitions, there's a significant risk when you put two organizations together that in fact you lose some of your talented people, and essentially what happens is you can see a significant drop in motivation just at a time when the company is trying to shift towards a more human capital oriented company. So first part of the exercise is to go and look at the traditional financials. The second is to look at what the marketplace in terms of investors has already said about the company in terms of the gap between true value and the traditional financials. And the third piece is to do all that research that then starts to look at, well, what really is behind the numbers? How much alignment is there here between what the organization strategically needs to do as part of this shift and what it actually appears to recognize it needs to do? So that really was the exercise. It's a task to try and, through research, to go and look behind the numbers and look at the consistency and alignment with what's actually going on in the organization, and the degree to which that provides assurance or risk that the organization, in fact, is going to be able to come through that transition. And again, one of the other things is to look at organizations like AT&T, where it's particularly interesting, where they already put a large amount of money into both their dividend and capital investment. They don't have a lot of room to move in terms of seeing significant changes in earnings. And so I would say, you know, from a risk management point of view, they're walking a tightrope. So what we're trying to do is to say, you know what, from an investor's point of view, Standard & Poor's and Moody's look at its balance sheet and say, yes, there's a bit more risk here because of the acquisition. But we're looking at it and saying it's not just the risk of the acquisition. You can see on the chart that's in front of you, what we've done is we've actually combined what Moody's and S&P say on the right-hand side of the chart, which is, you know, these guys are in pretty good shape, BBB rating type of thing, whereas the OMR rating is much lower on the chart. And we're really saying that, look, this is beginning to present to you a window of risk and a window of opportunity, because we think from a human capital point of view, this organization has a significant risk that it isn't actually recognizing. If you look at its financials, there's nothing in there that even has been identified as part of its risk going forward related to human capital. And S&P and Moody's probably isn't paying a lot of attention to that. So this tool is designed to really provide a little greater transparency and insight for investors into where the risks are. So rather than sort of go into any more detail, I kind of leave it at that, Paul. I don't know whether you want me to go anywhere else or add anything else. As I mentioned, there is, I forget what the number was, Paul. It's about a 12-page report, I think, behind this one, isn't it? That has all the analytics and everything.
I was going to, I'll tell you one thing I'd like to focus on very briefly, Nick, if I could just scroll down here. If people can see those who've got a screen, under our total value review, we've got a heading here called Value, Strategy and Human Governance, because the human governance issues are paramount these days, and we can talk about some of the issues there later on. But it's an absolutely declared policy. So it's a declared policy that shareholders are afforded primacy at AT&T. And for an organization that now employs 280,000 people, to actually be publicly saying to any employee who who wants to read their website or look at their annual report, that the people we put first in this organization as shareholders sends a very interesting signal to such a huge workforce. And I think this report that's the starting point, I think, for our analysis, which is, who comes first in the eyes of the board and the directors of companies like AT&T, huge companies with huge issues to deal with. And regardless of whether they regard shareholders as their main stakeholders, I think every company accepts these days that they're meant to manage all the stakeholders and not just one group. And I think one of the key issues that comes out in these integrated reports is the extent to which a board and the executive team have a coherent view on how to manage everybody's expectations and to ensure that, particularly from an employee human capital point of view, that if they are expecting to get the best returns and the best value out of people, if I was an employee of AT&T, I'd be asking myself the question, well, if shareholders come first, what's in it for me and how much commitment do I have to give to this organization? But yes, Nick, going back to what you were saying earlier, if I just scroll down, this actual report is 5 pages long. That doesn't mean it covers everything in every bit of detail, but it gives you an idea of the sort of areas that we look at, the width and breadth of it, some of the concepts that underpin it, like the shareholder primacy idea. Here we have whole system thinking and management. Maturity analysis always tries to capture a picture of the whole system and sees the organization as a whole system. And Nick and I and Stuart will all attest to the fact that writing a whole system view of an organization is something new, and it is not easy. It requires a lot of skill, a lot of analytical insight to pull together what on paper might look like very disparate aspects of a business. For example, just below there, it's got R&D. Most organizations are still treated really as silos with different functions and different departments. And one of the key differences between an integrated report and a standard or conventional company report is pulling all these different aspects of the business together to get a complete overview of what's going on in it.
Can I just add a couple of things, Paul?
Yeah.
Back to that first one that you were focusing on in terms of the primacy of the shareholder, I think there's a couple of points here to make to people.
Okay.
The first is it really is a reinforcement of what I would call traditional management thinking relative to human resources, because it really says I see human resources as a cost, not as an asset in running the business. There is no question, and I think this is sort of shades of grey, that there's no question that they have to keep their eye on continuing to satisfy the investor. But we all know that that is an outcome at the end of the day from optimizing the other resources that they utilize in the business. And that's the second point here, that if we look at something like the integrated reporting framework, one of the concerns that I think Stuart and Paul and I have is that the work of the IIRC in the integrated reporting framework provides us a nice sort of, if I can sort of put it in building terms, it provides us a nice scaffolding around the building, because it talks about the 6 different capitals that the board and management should be concerned about, managing and optimizing all of them to the long-term sustainability of the business. But in this particular case, we can see that AT&T appears to be fairly traditional in the way that it approaches its view of the various different groups of resources, i.e. the capitals that it employs in the business. So it's not in any way trying to discount or reduce the importance of the shareholder and the investor, but it's really saying that, look, as a board and a management team, if you're going to sustain these outcomes for the shareholders, and they talk a lot in their annual report about the importance of increasing the dividend every year, etc. If I was a shareholder, I'd be saying, yes, but I want to look at what actually is going on behind those numbers, and how are you employing your sort of intangible assets in the organization. Are you depleting those to generate these earnings? Are you in fact enhancing those to generate these earnings? So even though it's a tiny little paragraph there that Paul has pointed out to you, it contains a lot of sort of background and messaging about the quality and sustainability of earnings into the future. The second piece is the R&D piece that Paul just talked about. Again, this provides us with an interesting bridge, because AT&T have a really great website that deals with their West Coast function that's set up to be R&D. And AT&T has a really good history. AT&T Labs has a significantly positive history of things that they've developed over the years. Unfortunately, we also know that some of the things they've developed, they weren't able to operationalize that effectively. But the point here is, I can look at how much you're spending on R&D as a percentage of revenue, and how much of your cash flow is going to R&D. And I can compare that to other companies in the industry. That's an interesting number. But what I really want to know is what's coming out of this. To what degree is this actually coming up with things that can be operationalized? And if you go and look at their website that talks about the R&D that they do, it actually says, even though they're spending a ton of money, if you compare the number of sort of ideas and improvements that are coming out of this investment, it is pretty abysmal compared to sort of stellar organizations that have built continual improvement into their operations, like Toyota, obviously. So again, this is another example of how we're trying to build a bridge between the financials and what else does this tell us about the quality of what's behind those numbers. So having R&D is great, but at the end of the day, it's to what degree is it actually being leveraged to build future capability you need to survive in the business.